US stock market has just dropped by 3% within a single day, retracing about 2 months worth of gains within a single Federal Reserve meeting. Jerome Powell, the Fed chairman, has effectively killed all the complacency and greed that has been building up in the market within the space of an hour. Now, this move down has been particularly violent and is quite scary, but does it mark the end of the bull market that started in 2022? Should we be bracing ourselves for a much larger correction in the stock market? Now, you may have seen one of our recent videos that was posted on the 9th of December titled, "This is Getting Dangerous." In this video, we highlighted the fact that active money managers had 100% exposure to the stock market. So we mentioned that this did increase the odds of a short-term 3 to 4% pullback in the stock market as a result of this overexposure. So just as the first point for this video, it's really nothing unusual to see a pullback like this following some overextended positioning. By the way, if you want to have access to our entire trading strategy on the market step by step, make sure you're subscribed to our website. We try to take you through these periods of volatility smoothly, sending buy and sell alerts for opportunities that we see. Now, what is very peculiar about this correction is how extremely rapid the unwind was, with the stock market moving down by 3% within just a single trading session. We've highlighted all of the instances where we've seen this over the last couple of years, and to many, this type of volatility is reminiscent of the price action that we had in the 2022 bear market. If we overlay an indicator called the VIX on top of the S&P 500, which actually measures the volatility of the S&P 500 index based on the options market, we see that this recent correction in stocks triggered quite an extreme spike in the volatility index, which is suggesting we're actually seeing quite a bit of panic in the market right now. Now, you can see most of the time when the volatility index of the S&P 500 reaches these levels, it actually doesn't stay here for very long, and the vast majority of the time, volatility actually cools back down. All of those temporary spikes in the volatility index actually corresponded to great buying opportunities for US stocks. The big exceptions, of course, were during the COVID pandemic and again in 2022 when the Federal Reserve was raising their interest rate very aggressively during this entire period. In both of these examples, you had much more powerful narratives that took the market down significantly lower for an extended period of time. So the question today is whether we have something that could cause volatility to stay this high or even go higher, causing additional downside in the stock market. If we don't, then this spike in volatility is just another opportunity to buy the dip during this bull market. To answer that, we have to look at what is happening on the US Treasury bond market. This is the 10-year interest rate on US Treasury bonds, and we can see more recently it's been rising quite aggressively. Just since early December, the 10-year yield has risen from 4.1% all the way up to 4.5%, which might not sound like much, but this is quite a substantial move up in US interest rates, and it's actually in the context of a much larger move up from 3.6%. This big move up in interest rates in such a short period of time is key to understand the move that we just saw in stocks. Because believe it or not, this is telling us that the market is not worried about an economic recession today. When we zoom out to see what happened to the bond market in the last 3 recessions, we see that the 10-year yield was moving aggressively lower both heading into and during the recessions that are marked by these gray bars that are officially determined by the NBER. Now, the reason that's so important for the stock market is because economic recessions tend to be the primary cause behind significant market corrections. The last 3 times we had larger than 30% pullbacks in the stock market were in 2020, 2008, and 2001. All of these were during recessions. So using the 10-year interest rate, we can understand whether a correction in stocks is being driven by recession fears or something else. For example, this correction that we had in July and August of 2024 was accompanied by aggressively falling interest rates. Here, financial markets were concerned about the possibility of a recession. Today, that's definitely not the case. We're currently experiencing a correction that's a lot more similar to the one that we had in April of 2024, October of 2023, and February of 2023. All of these corrections were fueled by rising interest rates, were actually caused by the fact that interest rates were rising too quickly, just like they are today. But as you can see, none of these actually derailed the bull market. They were just temporary retracements that were eventually bought back into. Again, possibly quite similar to the portfolio rebalancing that we're seeing today. Now, if we zoom out a little bit further to 2022, on the other hand, we do see back here that rising interest rates did pull the market down considerably lower for an extended period of time. That was a result of a much more extended and aggressive rise in interest rates, where the 10-year yield actually went from 1.4% all the way up to 4.3%, so more than tripling over the course of that year. So of course we have to ask whether a similar move in interest rates would be possible today, dragging the S&P 500 down for a similar move to what we saw in 2022. To us, for now, this still seems very unlikely. And one of the key reasons for that is on this chart right here. This is a chart that shows us the price of a basket of different commodities. So that includes things like cotton, wheat, copper, corn, all things that generally contribute to inflation. In fact, if we overlay inflation on top of this basket of commodities, we see that they are a very close match. The only difference being that with our basket of commodities, we can see what the price action is day to day instead of waiting for the monthly government data releases. And if we overlay the 10-year interest rate against this basket of commodities, we see the two are very correlated to one another. Now look at what was happening to commodity prices in 2022. They were surging higher, which was of course contributing to higher levels of inflation and causing this huge spike in interest rates that dragged the market lower. Today, we are definitely not seeing any of that. In fact, commodity prices are generally heading lower. And over the course of the last few months, we've actually seen interest rates diverge away from commodity prices. As you can see, that has happened before, like for example, in 2018, interest rates were rising, commodity prices were moving lower. Eventually, interest rates reverted back lower. We had the opposite divergence in late 2021, where commodity prices were surging and interest rates were falling. Eventually, interest rates snapped back up. Typically, you see interest rates come back to commodity markets instead of the other way around, because a big part of the influence behind interest rates is actually the Federal Reserve, that's quite often a little bit behind on what they should actually be doing with their interest rate. So yes, interest rates could rise a little bit more, maybe move all the way back up to this high in October, and that could cause a little bit more volatility in stocks. But without a pickup in commodity prices, we would expect this move to be short-lived and for interest rates to revert back down. And just like it was in late October of 2023, which coincided with a significant rally in the stock market, we would expect that to be the case as well today. So long story short, for now, we're not too worried about this correction in stocks. We believe the real risk to the market today is a recession, and this correction is not recessionary. The overall price structure of the market is still very much bullish, and counter-trend corrections during bull markets are nothing out of the ordinary. Now, keep in mind, however, that we can absolutely change our minds on this. We don't want to be right. We just want to be making money, staying on the right side of the market. So if over the next few months we begin to lose this bullish structure and the market gives us enough evidence that we should be shifting our allocation to a more defensive stance, that's exactly what we'll be doing. If you want to follow our entire trading strategy, all of our buy and sell alerts for a ridiculously cheap price, make sure to subscribe to bravosresearch.com.